Hey folks, let me ask you a question. How would you like to manage your own money and beat the fund managers, the so-called experts? How would you like to beat them every year? Would that be pretty cool? I'm going to show you how in this video. Let's go. Hello, everybody. It is Jeremy Whaley here from Trade Maestro. It's great to have you joining me. If you'd like to learn more about what we do, visit us over at trademaestro.com. In this video, we're going to talk about how you can beat the fund managers, how you can manage your own money, beat the fund managers, those so-called experts, and do it every year with a very simple process. So let me share my screen here, and we're talking about how we can beat the market and the experts. Here we go. Number one, here's what we're going to talk about today. We're going to talk about the facts. I'm going to introduce you to some truths about experts that you may not know. It's going to be some shocking truths too. So that's the first thing we're going to talk about. Then we're going to talk about how you actually beat the benchmarks, how you beat the market itself. And then we'll wrap it up with a simple system that anybody can do. Truly, anybody can do it. By the time you're done with this video, you're going to know the strategy. So you're going to know what you're dealing with. You're going to know what the tool is, the technique, and then you'll have the strategy for how you do it. So let's talk a little bit about the so-called experts. How well are they doing? Well, I really did not know these stats until a few years ago. My mother, she was, she had some retirement money from her years as a nurse. And one day I was at their condo and she says to me, she said, "Son, I don't feel like my money's doing very well. This guy's had it for 8 years and it's not growing very much. Can you look at it?" So I looked at it. Sure enough, this guy had been managing her funds in the middle of one of the biggest bull markets in history. And in over 8 years, just over 8 years, he had only grown the account about 9%. That's about 1% a year. It was awful. I was like, "Mom, this is horrible." The market was up 300% or something, maybe not that much, maybe 200% in that same time frame. And she was only up 9%. So I took her money and I started managing it for her and made her a lot of money. But they got me thinking. I was like, wow, I wonder how many other people are really struggling with what fund managers do. So I started studying it and started looking into it. And I discovered that the S&P 500 people, the S&P, Standard & Poor's, they actually published a study on this that I'm going to pull up for us here. And it's called the SPIVA study. You can find it. Let me share my screen here. You can find it at SP Global, spglobal.com. It is the SPIVA study, SPIVA. You can go just Google that, SPIVA. And what you're going to find in here are the stats about how people do, how fund managers do. And over a 10-year period, 83%. Actually, we'll start with 3 years. Over 3 years, 32% outperformed the market over 3 years, 32%. So, one out of every three over 3 years, 1 out of 3 fund managers outperform the S&P 500 and 67% underperform. Now that's not very good. I mean, when you really look at those stats, that's 1 out of every 3 fund managers is underperforming the S&P. But let's go a little deeper here. If you go to the 5-year study, look at the 5-year study. That's crazy. Over 5 years, only 25% outperform the S&P 500. What? 74% underperform. What? Okay. Let's go 10 years. 10 years, only 16.93% of funds outperform the S&P 500. 83% underperform. So what you're seeing here is you're seeing over time, it's not getting better, it's getting worse. What happens after 10 years? Think it gets better? You think it gets worse? Well, according to the website, they stopped giving us data. But if you scroll down a little bit here, they try to tell you that they don't have the data beyond 10 years, but it's not true, because if you scroll to the bottom of that thing and you download the full report, which I've done, I'm going to bring it up and show you right now. And you go to page 10 of this report. This is the 2021 report. It's the most recent one, at least from when I'm doing this video. Now, I followed this report for several years. I want you to know that. It never gets any better. It shifts a little bit, but it never gets any better. All right, so let me just read this to you. Funds underperforming their benchmark, absolute return. So 1 year, 2 year, 3 year, 5 year, we've already looked at that. Let's go to the 20-year column here. All large cap funds. So these are all, let me help you understand. These are all of the mutual funds that are managing large caps. So when you go to your retirement account and they help you allocate to large cap funds, this is what they're putting them in. Out of those funds, here's the stats. This is the real numbers. Against the S&P 500, 94% miss. What? 94% underperform. And you can go down the list, all these mid-cap, composite, small cap, S&P growth, value, mid-caps. I think we already said that. Small caps, more composites, REITs. And look at the numbers. Over 20 years, nobody is doing any good. In other words, it would be better to just forget the fund managers. Now, I know I have some friends that are fund managers, and they're wonderful people. They're wonderful human beings. Let me move this around so I can come back over to what I want to share. I got some good friends who are fund managers, and they're wonderful people. They have good intention. They want to help people. But unfortunately, the system is not set up that way. In order to beat the system, in order to beat the market, you have to have a top 6% fund manager. And here's the truth, folks. Most people just aren't going to be able to find one. You can't find one, first of all. Secondly, if you do find one, you probably don't have enough money for them to really be interested in managing your money. And so over a long period of time, your fund managers are doing more harm than good. That's the bad news. Here's the good news. You can beat them. You can beat the benchmarks, and you can beat the so-called experts. So let's talk about that. How do I beat the benchmarks? Well, first of all, let's understand what the benchmarks are. The holy grail of measuring market success are these so-called benchmarks. And the benchmarks are things like the S&P 500. Let me pull them up here. S&P 500, the other S&P indexes, the small cap, mid cap indexes, and then other indices in general, like the Russell 2000, the Dow Jones, and whatnot. So those are the benchmarks. Now, why am I, talking about benchmarks? Well, you've seen it in the news. The S&P goes down, the Dow goes down, the NASDAQ goes down. These benchmarks, these indices, they go down. So just because you're beating it doesn't mean you're making money. What it means is you're doing better than the index. And that is the goal. The goal of beating the benchmark is just that right there, just to do better. So in other words, let's take a look at this example right here. And this is the S&P 500 going into the COVID crash. Okay, so that's what the S&P was doing, making higher highs, higher lows, boom, boom, boom. You say, how do I beat it? As long as your line is a little bit better. That's how you beat it. That's the definition of beating the market. So when the market is down 35%, 38%, whatever it was, if you were only down 32%, you beat the market. In other words, beating doesn't mean you're making money. Beating just means you outperformed the benchmark. So I'm going to show you how to outperform all of it here in a minute. But just understanding that right there, 94% of market fund managers, they cannot just do that. They can't just match or beat the S&P 500. In other words, it would be better for you to just simply buy the index and walk away. It'd be better to just buy the S&P 500 and walk away, or buy the Dow, or whatever index it is, whatever benchmark it is that you're trying to match. It would just be better to buy that. I mean, forget the fund managers. And again, I'm sorry, like, I'm not trying to be hating on fund managers. There's some wonderful people, but the studies just don't support them. Most fund managers just are not able to outperform, and they charge a lot of money for that. 1%, 2%. My mom was paying almost 2% for a fund manager who was only earning her 1% a year. You do the math. She's losing money over time. And most people are doing that. And because people aren't educated, because they don't know what to do, they just they just put up with it. Okay. So I'm going to give you a guarantee right now of how to match the benchmarks. How would you like that? This is something you can do yourself. You can do it in your retirement account. You can do it in your IRA, 401k, 403b, whatever it is you're working in. You can do it in a self-directed trading account. You can do this yourself. You don't have to pay any fund manager fees. You don't have to, the most you might have are some broker fees, like, $5 a trade or $1 a trade. Like, it's not very much at all that you have to pay to do this. You can learn how to do it right now. I'm going to teach you right now. You ready? Here's how you do it. Here's the formula. I'm going to make it full screen so you don't miss it. The formula for how to match and beat the benchmark, not how to beat. The formula for how to match the benchmark is trade the related index ETF. Okay. Did your brain just short circuit just a little bit there? The related index ETF, what is that? Don't worry. Every index, the index is the benchmark. The S&P 500, the Dow, NASDAQ, that's the benchmark. Okay? So that's what we're going to try to match. Here's how you do it. You trade the exchange traded fund that is connected to that index. What's an ETF? An ETF is an exchange traded fund. Instead of buying into these managed funds where the managers cannot match the index, instead, what I'm going to recommend or suggest, this is not a specific trading advice, and it's actually not specific trading advice. This is just a technique. You're going to have to apply it in your scenario. But what I want you to consider doing is think about, instead of putting the money under fund management, buy an exchange traded fund. An exchange traded fund trades like a stock, but it is a fund. It trades like a stock. It's not a stock. I mean, it is. It's a stock, but it's not a company behind the stock. So instead of buying shares in Apple or Amazon or Facebook or whatever it is that you're buying as far as the stock's concerned, instead of doing that, you're going to buy shares in the fund. Okay? And then the fund is going to trade on the exchange just like a stock. Now, what is an index ETF? An index exchange traded fund is exactly what it suggests. It's an exchange traded fund that matches the holdings of the specific index. So when you look at the S&P 500, there's 500 stocks in there, right? What if you bought all 500 stocks in the exact weighting of the S&P 500 and you just did that? Guess what? You have an index fund. That's what it is. What if you bought all 100 shares of the NASDAQ 100? Or excuse me, all 100 companies of the NASDAQ 100 with the equal weighting, exactly like the NASDAQ 100 is weighted. What if you did that? Well, boom, now you have an index fund. What if you bought the 30 shares in the Dow 30 or 30 stocks in the Dow 30? What if you did that? All the shares that were equally weighted. Boom, now you have a Dow index fund. That's what an index ETF is. It's an exchange traded fund that trades the exact companies of the benchmark. Simple. So simple, a caveman can do it, right? So if you want to trade the S&P 500, here's the ticker you're going to trade, SPY. SPY is the index ETF that trades the S&P 500. By the way, it happens to be the most heavily traded exchange traded fund. It's the most heavily traded. Lots and lots of volume on SPY, SPY. All right, the next one to trade is QQQ. This is going to be the index ETF for the NASDAQ 100. Okay, DIA is the index ETF for the Dow Jones Industrial Average, and IWM is the ETF, the exchange traded fund for the Russell 2000. Those are the four biggies right there. Now, if you want to get into, let's say you want to trade the financial sector, there's an ETF for that. There's an exchange traded fund for that. If you want to trade the energy sector, you want to trade a different sector, there's different exchange traded funds for that. But if you just want to trade the benchmark, the S&P 500, the NASDAQ, Dow Jones, Russell 2000, you just want to trade those benchmarks, this is how you do it right here. Trade these index ETFs. Now we have matched the benchmark, and it's basically guaranteed. It's basically guaranteed to match the benchmark because that's what you're trading. You're buying the benchmark. So now you're already outperforming 94% of professional fund managers. Can you believe that? Without paying management fees, without doing a whole bunch of different things, you can match the benchmark without paying those so-called professional fund managers. Now you're feeling pretty good about yourself. So the question is, how could we, if we could, how could we beat the benchmark? Feeling a little proud, right? So how can we step up and beat the benchmark? Well, let me introduce you to a concept for how we beat the benchmark, and I'll show you the technique here momentarily. Number one, here's the strategy. We're going to trade the index ETF. That matches it. Now you say, how do I beat it? Here's how we beat the benchmark. We learn to time the trade based on a very simple trading system, one using primary trends and the moving average system. Now, you don't have to understand all of that because I'm going to teach it to you right now. in the next 5 minutes, maybe 8 minutes. We'll see. But this is the step right here. To beat the benchmark, we start by using the benchmark itself, the index ETF, and then we're going to time our entries and exits. So what do I mean by timing it? What I mean by timing it is not buying it and holding it forever. Whoever came up with this idea that we should just buy and hold forever, they're kind of crazy, because it's really not how the market works. And frankly, it's not how the best fund managers work. Best fund managers time their entries. They get in at certain times, they get out at certain times. Individual traders can do the same thing. You can do that, okay? So this whole idea of I'm going to buy it and I'm going to hold it for 20 years and see what happens, it's a really bad idea. Some people get rewarded for that, but what's a better technique is to know when to buy and know when to sell. Okay, so what we're going to do here is I'm going to show you a simple technique where we're going to beat the benchmark by starting with the benchmark itself. So that already beats fund managers. And then we're going to time our entries and exits. You say, well, how can I possibly do that? I've been told you can't do it. Oh, yes, you can. I'm going to teach you right now. Okay, I'm going to give you one tool. There's a lot of tools that we can use for timing the market. It's one of my specialties. It's part of what we do here at Trade Maestro, but I'm going to give you a very simple system that anybody can do. You say, what is it? Here it is. It is the moving average system. And this system, what it does, the moving average, what it does is it smooths out the price action and helps you see the trend. So you know if you're in a bullish trend or a bearish trend, if the market's going up, if the market's going down. So that's the technique that we're going to use. Okay, so before I lose you, because I'm giving you a ton of information all at once, let's just kind of backtrack. We saw the stats. The so-called professionals are not that great. The so-called fund manager experts, they're not doing that great. 94% of them, 94%. It just blows my mind. 94% cannot match the benchmark. You say, how do I match the benchmark? We just buy it. We just buy the benchmark itself. Now we've solved part of the problem. How do we beat the benchmark? That's where the timing comes in. So what I'm going to teach you right now, the tool we're going to use for that is the moving average. That's the moving average system. So I'm going to teach you right now, okay? So let me give you the keys to the moving average system. Here's how we use this, and I'm going to show you some examples momentarily. Number one, when the price is above the moving average, the trend is up. It's that simple. When the price is below the moving average, the trend is down. It's that simple. When the price is in the middle of the moving average, and the moving average is in the middle of the price, it's sideways, the trend is unclear, we need more data. How simple is that? I mean, that's it. If we're above the moving average, we're bullish. Below the moving average, we're bearish. If the moving average is moving through the price, hold tight. Let's wait and see what happens. Give you some examples here, okay? Coming over to full screen, this is the SPY. This is the S&P 500. Notice the green line, that's the moving average. Notice when the price is above the average, we're trending higher. When the price is below the average, we're not. Okay, so it works for SPY. Does it work for other stuff? Yeah, how about this one? This is ExxonMobil. Notice when the price is below the average, we're trending down. When the price is above the average, we're moving higher. It can't be that simple, Jeremy. Oh, but it is. One of my primary tools that I use to trade and beat the market. Tesla, price is above the average, and, well, it's Tesla. The price is always above the average. No, that's not true. But yeah, when the price is above the average, we're trading higher. Apple, price above the average, we're trading higher. Price below the average, we're not. Amazon, price above the average, we're trading higher. You guys get the idea here? I can go trade after trade after trade after trade. This tool works on any stock, any ETF, anything that you're going to put it on. The moving average is a great tool. It's simple. All of you can do it. Okay? So here are the keys. When the price is above the average, the trend is up. When the price is below the average, the trend is down. If the price is moving in the middle of the average is moving in the middle of the price, then the trend is unclear. It's first step. Let's go to the next piece here. The next piece is when we put two averages on the chart. So the first step was one average. Now we're going to add a second average. When those averages cross, it gives us a signal of a change in direction. So we're actually adding a confirmation piece here, okay? Signals a change in direction, and take a look here at this chart. Notice on the far left over here, the green circle, averages, actually they hadn't crossed. They started off with the white one above the green one. And then notice right here, the white one crossed the green one and the trend is up. Right here in this green circle, the white average crosses the green average and the trend is up. You say, when do I get out of the trade? Well, look at the red circle. When the white average crosses down below the green average, get out of the trade. Over here where the red circle is, when the white average crosses down below the green average, get out of the trade. That would have saved you. That one circle right there would have saved you if you lost 35% of your retirement during COVID. That one tool would have saved you right there. Yep, that's it. Okay, you say, will this work on other stocks? Absolutely. Let's take a look over here. ExxonMobil. When the white average is crossing above the green average, it's a buy signal. When the white average over here is crossing above the green, it's a buy signal. Over here, when the white average is crossing above the green average, it's a buy signal. What about the red circles? This is sell signals. Get out of the trade. White average is crossing down. This is called a moving average cross. It's one of the best signals you'll get. Now, what about these areas in yellow that I'm highlighting where the price is all back and forth? The price is one direction, averages are another direction. These are confusion. Okay, these are sideways moves, and I'll talk about those. I'm not going to do it in this video because it's just too complicated to do that right now, but there's other ways that we approach that. Okay, and there's other tools that we can use during those sideways moves. But for now, here's what I want you to have. It's really simple to trade this system. Am I above the moving average? If the answer is yes, then we ask the second piece, is there a moving average cross? And if the answer is yes, then it's a buy signal. It's that simple. Now, those two steps I just gave you, here, I'll put them right back. These two steps, they prevent sideways markets. When the market's going sideways, you will not get these in this order. Okay? So these in this order, this is like the dummy-proof version of how do I pick the trade direction and beat the market. This is it right here. Okay? Now let me give you my settings for the moving averages. Can we make it more complicated? We can, but I'm not going to. I'm just going to give you the settings right here. All you have to have is charting software, something like TradingView, which is what I use. But any charting software we use will work. And set your moving averages up. Now, I use 3. I don't use 2. I use 3. Okay, I showed you 2. I just add a third one. And these are the settings that I use. I use an exponential moving average. You can use a simple moving average. That's fine. But I use an exponential moving average. I use a 10 period, a 20 period, and a 50 period. And I've been doing it for years. Yeah, I'm giving you all my secrets right here. Okay. So with that basic system, let's go back and let's look at the S&P 500 going through one of the most traumatic times of S&P history when the COVID crash happened, 2019, 2020. And I just kind of want to show you. And the reason I'm doing this is because people always ask, they say, well, could you have known? What would have happened during the last big bear market? Well, I'm sharing it with right now. I'm sharing it with you. Okay. So here's what would have happened over this 2-year period of time if you put those 3 moving averages on there, and when the stock price, in this case, the SPY, so that's S&P 500, when we're above the averages and the averages are crossing, we're going to buy. We're going to buy about $260 a share. When it crossed down, we sell at $285. When we buy back in, $285, crosses down, we get out at $300. Okay, we have a little yellow period here where we don't do anything. We actually, maybe buy and sell again at 300, or maybe you just didn't do anything. Then the next buy signal came around at 300, and the next one, exit signal, came at 330. The next buy signal came at 285. The next exit signal came at 340. And then we had a little bit of wishy-washy again, and another buy signal at 340. During this 2-year period of time, 5 trades, 5 profitable trades, 2 or 3 break-even trades. Total gains, $145 per share, giving a 60% return on investment. And in the process, you avoided the emotional trauma of the 35% drawdown during COVID. Mic drop. Mic drop. Right there. I'm going to tell you a sad story. Okay. I'll leave the person's name out of it, but client that I have, she's here in Nashville, Tennessee, where I live. And there is a fund manager in Nashville who's on the radio all the time. He's on talk radio and he does all these shows and he's always talking about you can't time the market. And he gives all this traditional fund manager wisdom. Okay. And he has a huge client base here in Middle Tennessee because he's on the radio. People trust him. Well, this particular client of mine, she had her retirement managed with him. And during the middle of COVID, she called me in tears. And she said, such and such is managing my money. I'm not going to give his name. But she said, such and such is managing my money. And I'm down 73%. I don't know what I'm going to do. The market itself was only down 35%. And she was down 73%, freaking out. It's unnecessary, folks. There's no reason to have that kind of drawdown on your account. There's no reason that fund managers can't do what I just taught you to do. In fact, if fund managers would just do what I taught you to do, they could beat the market and they could outperform the market. But 94% of fund managers cannot even match the benchmark, much less beat it. You have the ability to do that. Now, using this exact technique as I've shared with you over 1 year, here's what you would do. 28%, timing the market yourself, you'd earn 28% versus 11.8%. So that's almost 3 times as much. Over a 2-year period, over the 2 years that we tested this, is a 60% gain versus a 53% gain. And over a 5-year period is 133% over 95%. So just matching the benchmark is going to be better. Or is going to be good, I should say. It's going to be better than the fund manager. But if you can do the timing piece, if you add this one little technique, you're going to beat the benchmark and you're going to beat the fund managers and you can do it all yourself. Okay, so what tools do you use for this? I've just given you the techniques. Let me give you the investment tools. SPY, if you want to trade the S&P 500, you want to match that, use ticker symbol SPY. If you want to match the NASDAQ 100, use ticker symbol QQQ. If you want to match the Dow Jones Industrial Average, use ticker symbol DIA. If you want to match the Russell 2000, use ticker symbol IWM. Okay? The strategy, it's really straightforward. It's really simple. When the price is above the moving average and all 3 moving averages confirm with that moving average cross I showed you, buy. That's simple. And when the price drops below the moving averages, specifically the 50 period or the 10 period crosses down below the 20 period, when that happens, sell. Now you can play with that. You can tweak it a little bit. There's lots of different ways we can do that. But that right there will help you beat the benchmark. And just if you match the benchmark, you beat the fund managers. If you beat the benchmark, well, you could be the fund manager. I'm not saying you should do that. In fact, I don't think you should. It's too much work, too many rules and too many regulations and crazy people to deal with. Here's how you do it, folks. Beating the benchmarks. Recognize you can do better. That's the first step. Recognize that just by simply buying the index ETF, you're going to match the benchmark. That's the first thing to recognize. So that's second thing. Trade the index ETF. And then finally, we're going to time our trades based on that moving average system. And when you do that, not only will you beat the fund managers, you will beat the index itself. And guess what? We're just getting started. There's so many things I could teach you about this, but this right here is all you need to get started. Now, what should you do next? If you want to learn more details, you want to like really dig in and say, yeah, I want to learn how to beat the fund managers and beat the index, beat the benchmark. Well, sign up for my Trade Maestro membership where I'm going to give you access to all of this stuff. Let me teach you how to do this the right way, because there's a lot of people that teach people how to trade. I've been teaching people since 2008. So depending on when you're watching this, about 14, 15 years ago. I've been trading the market since 1999. So I've got, pushing a quarter of a century in the market at this point. And this is what I do with my own money. This is what I do with my parents. I help my parents manage their money, and I do it with this stuff here. Same techniques, same strategies. With my Maestro membership, what you get is you get a monthly membership. You can cancel it anytime. Okay, there's no obligation, there's no contract, no long-term commitment. Just simply, if you try it for a month, you're like, I decided I don't like it. Well, just cancel it. It's that simple, okay? So you can get your monthly membership, and what you're going to get is you can get live weekly analysis every Sunday night we're going to do market analysis. I'm going to do overview of what's happening with the Dow, with the S&P, with the NASDAQ. And then you can use these ETFs that we've just talked about to get into those trades. In fact, we talk about these specific ETFs and we do trade setups on them. And we also look at other individual trades that you might want to get into. And when we're dealing with bear markets, we look at strategies for how you beat the bear market. Like we have strategies for all of it, and we cover all of that in our Sunday night. We call it Profit Picks. We do that every Sunday night. In addition to the live Sunday night classes, which are recorded, by the way, so if you can't make it, then you just watch the recording. In addition to that, you have access to the entire recorded trading library. And so you can come in there and learn about the moving averages, learn about chart patterns and other stuff that we didn't even get into today. So you can learn about all that stuff. It's all right there in the trading library. I also have my Pick Winning Stocks Challenge, which is a $500 training teaching you my entire trading system and just little short, like 30-minute videos like this. And you go through them and you can get my entire trading system, the moving average system. You're going to learn how to pick the trade itself. You're going to learn the timing of the trade. You're going to learn risk management. All that is in the Pick Winning Stocks Challenge. It's incredible. It's $500 value, and I include that with your membership. Plus, in addition to that, you're going to get 2 monthly group coaching sessions. Usually, sometimes it shifts, but usually it's the first and the third Wednesday of the month. We get together. We do a live group coaching session. You can open your microphone, ask, talk questions. Made no sense. Ask questions, talk with me. Ask, talk questions. Yeah, whatever. You can ask questions, talk with other people, talk with me, and you'll be part of the Maestro community. All right, so it's a great membership, and if you're looking to beat the market, you're looking to outperform the fund managers, this is a great place to start that. Okay. Now, I have an extra little bonus for those of you who decide to do an annual membership. Annual membership is exactly like the monthly membership, except you save money. Okay, so monthly membership is $97 a month. The annual membership is basically the same thing, but you save 2 months worth, which is 17%. So you pay $970 for the year, and then you pay 10 months, you save 2. All right, so 17% savings, but as a bonus, I'm also going to give you, for all the annual members, I'm going to give you a Mastering TradingView training. So that's the charting software you see me using. I'm going to give you a training on that so you can master the charting software. This is a $300 value. I'm including that for free for all the annual members, and I'm also including my crypto course, my crypto accelerator course. It's a $1,000 training. I'm going to give that to you for free as well. So basically, it pays for itself. There's no reason to not do the membership, and there's no reason to not do the annual membership. But, do whatever you need to do for you. You can get access to all of it over at trademaestro.com. If you have any questions, just reach out. Help@trademaestro.com. Help, H-E-L-P. Help at trademaestro.com. Make sure you spell maestro right, M-A-E-S-T-R-O, trademaestro.com. All right, thank you for watching. I hope this has been helpful. Let me know in the comments and the questions. Give me a little bit of feedback here. And if you've not subscribed, then by all means, get yourself subscribed to my YouTube channel. If you're on Facebook, subscribe over on Facebook or wherever it is that you're watching this thing. Get yourself subscribed because that's what you need to do. All right, get yourself subscribed and you can stay up to date with everything that I send out. All right, thanks again for watching, and until next time, happy trading.